Assalamualaikum and good morning. Today we will discuss another chapter or another topic for the subject, which is international sustainability reporting. Or sometimes maybe the more familiar for you is the terms of corporate CSR, which is corporate social responsibility. Okay, so this is the learning objective for this topic. So we will, there are 6 learning objectives. First, the students should be able to explain what is the meaning of sustainability reporting, explain why companies publish sustainability reports, describe the difference between traditional and social responsibility investor, and discuss why each group would have interest in information conveyed by sustainability reports, explains how companies use promulgated by GRI to prepare and organize information in a sustainability report, explain the concept of non-financial materiality and its importance in sustainability report, and describe the difference between GRI and the Sustainability Accounting Standard Board, which is SASB. Okay, so actually sustainability reporting augments traditional financial reporting by providing information about an enterprise environmental and social policies and practices. So we said that sustainability reporting is one of the added value, or added segment in the traditional financial reporting. So the development expansion of this augmented reporting framework over the last 20 years is, we cannot argue, because it's become the most important trend in the modern accounting. Today, if you look either in the news or if you read in the article, most large public companies around the world practice some form of sustainability reporting, which is most commonly they will publish a separate standalone sustainability report. And if we look in 2016, 81% of Standard & Poor 500 prepare one, there means 81% of this list in the Standard & Poor prepare one, at least one, the sustainability report. Okay, so there are another method of disseminating sustainability information is actually, of course, through an integrated report, which weave sustainability disclosure into the company annual report. That's why we said that sustainability reporting is actually augments of the traditional financial reporting. And this integrated reporting actually has grown more common in recent years. Okay, so basically the sustainability report can be divided into few dimensions, which is basically it's divided into environment dimension, social capital, human capital, business model and innovation, and also leadership and governance. So if you read the sustainability reports in the annual report of the company, basically the dimension is this 5. Basically they will be divided into according to this 5 dimension. So there is a large variety in reported structure and inconsistent use of terms. So if you read the annual report, the structure will be different from. That's why we said a large variety. And if you read, it's not necessarily divided into each of these dimensions. And sometimes the terms of use in one annual report is different with another annual report. And the sustainability report, so far, normally it's largely voluntary. It's voluntary basis and unregulated. Means it's not required by the law. Okay? And US companies sometimes refer this is as CSR reporting. Okay? But right now it's actually, if we look, the term of CSR reporting is more popular than the sustainability reporting. Okay, so when we look, so what is the theory to explain emergence of sustainability reporting? Okay, so as we see that sustainability reporting experienced explosive growth in the first decade of the millennium. So this growth is best proven by the number of companies which publish annual sustainability report with the framework established by the GRI. So GRI is one of the framework that most widely used to report the voluntary or to report the sustainability reporting. Okay, so there are a number of theories explain the dramatic growth. So among them, there are actually a few theories, but the most famous is the stakeholder theories and the legitimacy theories. If we look on the stakeholder theories, the stakeholder theory posits that companies make social and environmental disclosure in response to the stakeholder demands for social and environmental information. Okay? So this is stakeholders theory. So management, because of the demands of the stakeholder just now, so management respond to public pressure by stakeholder is by voluntarily disclosing this information. But the major problem with this theory, okay, considered apart from other motive, is that it failed to explain why firms from similar industry operating in the same geographic area provide the different disclosure. Okay, so as I said just now, the structure or the reporting of the CSR, I will use CSR, okay? The reporting of CSR is very, okay, and largely variance. The variance is very big. Okay? And according to the legitimacy theory, the second theory, okay, sustainability reporting is a tool. They look it as a tool that assists companies in dealing with exposure to political, economic, and social pressure. So the difference between these two, this is the pressure from the stakeholders, but this is the legitimacy theory, is the pressure because of the political, economic, and social. Okay? So firms behave in a way that is considered to be congruent with the society perceived goal to legitimize their performance. Okay, so because of we have the perception, okay, the society perceive that the company must act like this one. So that's why the company will behave like that one. So accordingly, legitimacy is a condition or status which exists when an entity value system is congruent with the value system of the larger social system, which is we refer to the political system, economic system, and social system. Okay? Okay, so next, okay, so when we look what is the demand of the investor for the sustainability information, okay, because we said just now, if we look on the stakeholder theory, okay, the company provides the information because of the pressure for by the stakeholders. Okay, so the most important user of when we are talking about the traditional financial report. Okay, so the most important user of the traditional financial report, of course, the company owners, which in publicly traded corporation, if we are talking about the public company, of course, the shareholders. Okay, so while sustainability reporting is generally aimed at a wider set of users. Okay, so it's not only aimed for the shareholders only, but it's also emphasis that investors give to social and environmental performance, which is grown dramatically in the recent year. Okay, so to understand the investment community demand for the information content in sustainability report, it is useful if we separate the investor into two classes, okay, or two types. One we call as traditional investor, and number two is we call as social responsibility investor, or in bracket we call as SRI. Okay, so when we divide this one into two, okay, so we said who is the traditional investor? The traditional investor is the person who focus on a company profitability and stock performance, while the SRI is the investor who makes social and environmental performance a significant factor in their decision. So what is the distinction between these two groups? The distinction is not clear-cut. Okay, so why I said it's not clear-cut, when we said that the SRI, they need the social and environmental performance. Okay, this is the significant factor when they make the decision. It doesn't mean that the traditional investor is irresponsible towards the environment. Actually, both group, this one and this one, both group is care about social and environment. But what is the difference? The difference is the emphasis given on these matters by the group. Okay, so we said the SRI put more emphasis on the social and environmental performance rather than the traditional investor. So this is the difference. Okay. Okay. So what kind of information needs of a traditional investor? If we analyze the research done by the academic study in the economic, finance and accounting, they provide a support for the view that companies with superior social and environmental performance also outperform their peers financially over the long run. Okay? So this outperformance has been found in study of both accounting metrics such as GAAP profit or operating cash flow or stock market returns. So if you read article, most of the article will conclude the same things. Okay, so the explanation for this outperformance that fit traditional investment framework posit that social and environmental factors is actually correlated with the many traditional recognized success factors. Yeah? So what is the success factor according to the traditional investment framework? Okay, it's include government issue. It's include the government issue, the governance issue like the executive compensation, board structure, procedure for long-range planning. Also, we are talking about the successful investment either in the intangible assets such as energy conservation. Okay. Better identification of, efficient cost cutting, okay, which of course will lead to reducing of use of energy, water, etc. Okay. Better identification of emerging business opportunity, for instance, those associated with organic foods. Okay. The avoidance of declining product and industry, for instance, we are talking about tobacco product, okay? And the risk mitigation, including how company deals with threats to workplace and product safety. Remember, when we set the information needs of traditional investor, this one, we are talking about what is the information in the CSR or in the sustainability reporting, which kind of information that are looking by the traditional investor. We are not talking that information needs by the traditional investor in the traditional financial report. But we are talking about what information needs by traditional investor in the sustainability reporting. Remember, as I said before, when we are talking about two types of investor, we are talking about the emphasis or the focus of these two type of investor towards the environment and social matters. Okay? So, social and environmental performance. So, as a traditional investor, which are, they focus more on profit, okay? They focus more on profitability and stock performance. Therefore, when they are looking for the sustainability reporting, they will look on the information that relate to the traditional success factor. Okay, so they will look the information that is related or correlated with traditional success factor. So, among it is all factors. Okay, and if we look another type of the second class of the investor just now is social responsibility investor. So, for the social responsibility investor, it's a little bit different, okay? Because for this kind of investor, they will use the social and environmental performance of the company to evaluate its investment. Okay, so if we look, the Forum for Sustainability and Responsible Investment, an interest group which is comprised of SRI just now, okay, will focus on institutional investor, and they categorize this actually SRI into SRI investment strategy into two. Okay, so this is the strategy that made by the SRI just now. Okay, one is those that screen for negative attributes to avoid, and number two is those identified as promoting a positive impact. So what kind of information that are looking by SRI just now, social responsibility investor, they will look the information based on their strategy. Which type that we are looking for? Either they will screen for the negative attribute or they look for the promoting of positive impact. Okay? So for example, for those that screen for negative attribute, okay, to avoid, for example, pension fund for doctors that prohibit investment in tobacco, okay. Avoid industry, they will avoid the industries such as coal, gaming, or those with child labor problems. Okay, so they will look in the information, either this company use child labor, or either this company is coal industry or gaming industry. So this is what we said, that if the SRI, the social responsible investor, fall under this category, they will screen for the negative attributes. So they will avoid to invest in this type of company. Another strategy for SRI is when they read the sustainability reporting, they will look the report, the information that promote the positive impact. For example, they will look that company which is good in the energy conservation, okay, which is focused on alternative renewable energy development. So they will look on the green type of company. So this type of company is very important when they make a decision to invest. Okay, so this is the difference between, we said the information, the difference in the information needs by these two types of category of investor. Okay, so we will stop this video. Okay, and we will continue in the